Have you ever heard the quote, "Be greedy when others are fearful"? Warren Buffett famously said that, and honestly, people need to be reminded of that advice because everywhere I look, the headlines, the social media, even in everyday conversations, there's just fear. People are panicking over tariffs, global news, and of course, the stock market is down bigly. I posted something, just a simple reminder that, hey, when the market dips, that's not always a bad thing. It could be a great buying opportunity, especially if you are a young investor. And I shared this chart of the SPY ETF, basically a snapshot of the entire market. And man, you guys went off. My comment section, it was brutal. I got roasted. People saying stuff like, "Do you work on Wall Street? The financial disaster has just begun." With how Trump is alienating the rest of the world and his blazing incompetence, we don't have the rest of the world to help us out. And my personal favorite, unfollow anyone who gives advice like this. Okay then, bye Felicia. Through the noise, though, there was this comment that nailed it. Markets are emotional, but history shows long-term growth. Patience is key. Exactly. So yeah, this post blew up 4 days later, and I'm still getting comments. I also got 4 or 5 hate messages. But if there's one thing that I've learned, it is that staying calm when others lose their head is one of the best skills an investor can have. I've been doing this for over 10 years now, so before you let fear drive your decisions, take a breather, zoom out, and think long term. And let's be real for a second, most of us aren't foreign policy or trade experts. And if you've been paying attention, this isn't the first time that tariffs have been tossed around like this. Remember when tariffs were announced on Canada and Mexico, then they were walked back, then they were back on, then they were back off? I mean, it's kind of his thing, the back and forth style. It's part of his negotiation tactic. And honestly, the world of tariffs is far more complex than the headlines make it seem. I actually started digging into it, and it's not like, oh, this country is slapping a 20% tariff on our dairy. It's more like after you export a certain amount, then the tariffs kick in. Anyway, back to this post. I'm not just talking, I've got real skin in the game. When I made this post, I had already purchased 10 shares of VOO on Thursday and then another 5 shares on Friday. And I'm not stopping there. I've been investing consistently for over 10 years. I started with just $50 a month 10 years ago, and today that has turned into a multi-million-dollar portfolio, which obviously is down right now. I actually break it down into another video, but the bottom line is that my strategy hasn't changed. I just keep buying. And it's not just with stocks. I've got skin in the game in business as well. I recently launched a coffee brand where I'm importing beans from Vietnam. For the test run, I purchased just 1 ton of coffee. Everything went smoothly until now. For the next shipment, I am already hearing that price is going up. On top of that, I ordered packaging from a supplier in China. So yeah, it's hitting me from both sides. I honestly don't think that I'll be profitable this round, but I'm still investing and I'm still staying optimistic because even though it's messy right now, I really believe that in the long run, this could lead to something positive. Now, a bunch of the so-called experts in the comments are saying that the markets are not done dropping and that this is nowhere near the bottom. But let me show you something. Take a look at this chart. This kind of study has been done multiple times by many firms over the years, and the takeaway has always been the same. You just cannot time the markets. Trying to avoid the drops often means missing out on the rebounds as well. In fact, 78% of stock market's best days happen during the bear markets or right in the first couple of months of a new bull run. If you miss just 10 best days in the markets over the past 30 years, your total returns would be cut in half. Miss the top 30 days and your returns drop by a jaw-dropping 83%. So yeah, sitting on the sidelines waiting for the perfect time to buy, well, good luck with that. And by the way, March 2020 wasn't too long ago. Markets were down, 30% in just a few weeks. Everyone thought that the world was ending. And yeah, I was scared as well, but I kept buying. I bought VOO back then and I'm buying VOO right now. By the end of the year, the markets had fully recovered and anyone who held steady came out stronger. Same with 2008. The people who kept buying during the crash, well, they made life-changing gains in the years that followed. I personally know someone who cashed out their entire 401k in March 2020 because they could not stomach the losses. And as you know, the markets rebound faster than anyone had expected. They did not get back in until months later, and by then they had missed most of the gains. That's the danger of emotional investing. This person did not just pay 10% in early withdrawal penalty, but they paid taxes and then obviously they cashed out at the worst possible time. I call that a triple whammy. One thing you have to understand is how the media operates. Fear sells. Headlines like "market crash ahead" or "stocks plummet" grab clicks, views, and attention. Good news does not get nearly as many clicks. So if you're basing your investment decisions on scary headlines, you are already fighting a losing battle. Headlines are meant to startle, not to guide your investment decisions. Recognize them for what they are, a business selling your attention. I started this video with a very famous quote from Warren Buffett that be greedy when others are fearful. But people misunderstand this quote all the time. It does not mean throwing all logic out the window. It means recognizing that most people act emotionally with money. When prices fall, people panic, but that fear is usually when the real opportunity begins. You do you, but I will continue to dollar cost average my 4-fund portfolio. Here are some other comments that I think are worth reading. Careful one advice to give. It's still very overvalued, and people can come after you for giving that advice. Please come after me. I mean, I clearly mentioned that this is my opinion only. This is not financial advice. And by the way, 9 out of 10 people who know what they're doing will tell you that this is actually good advice. This aged well. Total loser. I mean, he's completely missing the point, but whatever. Anyone who says that this is not the time because this is not the bottom is wrong. There's a term called dollar cost averaging. It means regardless of what the market is doing, you invest. You invest when it's high, you invest when it's low. And when it's low, it's even better. You're buying at a discount. Time in the market is much better than timing the market. This guy gets it. No one has a crystal ball, so there's just no point in trying to predict when and how much the market will fall, like half of these experts in the comments. Ryan writes, it's going to get worse before it gets worse. Okay, Ryan, that's enough CNBC for the day. You've probably heard it before, but I think it's worth repeating. It's not about timing the market. It's about time in the market. Think of investing like planting a tree. You don't dig it up every few months to see if it's growing. You water it, you wait, you let time do its work. If you're jumping in and out, trying to outsmart every dip or rally, you're slowing your growth. Long-term wealth comes from patience and not perfection.